Welcome back, everyone, for another deep dive. And this time, you guys have really outdone yourselves. You sent us a challenge, and, well, challenge accepted. We're diving headfirst into the world of technical analysis.
Buckle up. From the looks of these charts, it's going to be a wild ride.
Yeah, I'm already seeing more squiggly lines than a seismograph during an earthquake. Someone really needs to invent a financial dictionary because, honestly, it's like reading another language.
Well, in a way it is. It's the language of the markets, and like any language, it takes a bit of effort to grasp.
True, true. But hey, that's why we're here, right? To break down complex topics into bite-sized pieces. So, where do we even begin? It seems like technical analysis ditches those long economic forecasts and dives right into the fascinating world of charts.
Charts, graphs, indicators. Think of it as a way to visually understand the battlefield of the markets.
So, like a financial war room with all those blinking lights and maps.
Something like that. Our source defines technical analysis as the study of past market data, mainly focusing on price and volume to identify patterns and trends.
Okay, patterns and trends. Got it. But how can looking back help us understand where the market's heading? It's not like we can just rewind and replay, right?
You're right, we can't rewind, but we can learn from the past. Think of it like this. Imagine you're trying to predict the ocean's tides. You probably look at historical tide charts, right? Technical analysis is similar.
Ah, so it's about spotting those waves before they crest, riding the momentum of the market.
That's a great way to put it. Technical analysis tries to find those repeating patterns in the seemingly chaotic sea of financial data.
Okay, I'm starting to get the picture. But what about all those other factors that everyone seems to focus on? The news, economic reports, even a company's financial health. Do those not matter in this world of charts and patterns?
That's the fascinating part. One of the core principles of technical analysis is that it strips away all those external factors.
Wait, really? You're telling me we can ignore the headlines and just stare at charts all day?
Well, not exactly ignore, but the idea is that those external factors, those headlines, are already baked into the price and volume of a stock or asset. Technical analysts believe these two data points tell the whole story.
So it's like saying, forget the scouting reports and expert opinions, let's just analyze the team's win-loss record and go from there. Is that too simplistic of an analogy?
Not at all. That's a great way to understand it. Technical analysis focuses solely on the historical price and volume data, believing it holds the key to predicting future market movements.
It's a bold approach, and I'm sure there's a lot more to uncover. But before we get lost in the weeds, I gotta ask, how do we actually make sense of those squiggly lines? I keep hearing terms like support levels and RSI, and frankly, it all sounds a bit like gibberish to me.
Haha. Well, every field has its jargon. Don't worry, we're here to decode it all. Let's start with those support and resistance levels you mentioned. They act like boundaries for a stock's price. Imagine a price bouncing between a floor and a ceiling. The floor, that's your support level, where the price tends to hold and bounce back up. And the ceiling, that's your resistance level, where the price often meets resistance and falls back down.
So it's like a channel, kind of like a river flowing between its banks.
Exactly. And just like a river, those banks can widen or narrow depending on the market's mood, which brings us to the concepts of bull, bear, and range-bound markets. Ever heard those terms thrown around?
Oh, yeah, definitely. Bulls charging ahead, bears hibernating, and what was the last one?
Range-bound. Think of it as a market stuck in a holding pattern, not quite ready to break out or break down.
Okay, got it. So we've got our support and resistance levels, our market moods, but what about those alphabet soup acronyms you mentioned earlier, like RSI? Those still sound pretty intimidating.
Think of those as your tools of the trade, indicators that help interpret those price movements we've been talking about. RSI, or Relative Strength Index, is like a momentum gauge for a stock. It tells you if a stock is overbought, meaning it might be due for a pullback, or oversold, suggesting it could be poised for a bounce.
Ah, so it's like reading a speedometer, seeing if stock is speeding up, slowing down, or about to slam on the brakes.
Exactly. Then you have other tools like moving averages, which smooth out those price fluctuations on the chart, and MACD, or moving average convergence divergence, which uses multiple moving averages to spot potential buy and sell signals.
Okay, you lost me a bit at MACD, but I'm definitely getting a crash course in chart speak. So we've got our support and resistance, our market moods, and a whole toolbox of indicators to help us decipher those squiggly lines. Speaking of patterns, I was fascinated to learn that the history of technical analysis goes way further back than I expected. It's like a hidden world of market wisdom.
It's true. The roots run deep, and it's actually quite fascinating. Our source even links technical analysis back to chaos theory, this idea that even in seemingly random systems like the financial markets, there are underlying patterns that can be identified and potentially used to our advantage.
Hold on, are you telling me there's order in the chaos? My mind is officially blown.
It's a mind-bending concept, isn't it?
Yeah.
But think about it, even in randomness, there can be repeating patterns. And those who subscribe to technical analysis believe that by studying these patterns, they can gain an edge in the market.
All right, you've officially convinced me that there's more to charts than meets the eye. But how did we go from these early theories about patterns and chaos to the sophisticated trading platforms we have today? Talk about a technological leap.
It's been quite a journey, that's for sure.
Yeah.
The source mentions figures like Charles Dow from the 19th century. You might recognize his name from the Dow Jones Industrial Average.
The Dow Jones, wow, so that index has been around that long.
It has. And it's a testament to the enduring legacy of technical analysis. But things really took off in the 20th century. First with computers allowing for more sophisticated analysis, and then the internet and online trading platforms democratized access to these tools. What was once exclusive to Wall Street is now available to anyone with a computer.
It's incredible how accessible information is now. We've covered a lot of ground. What technical analysis is, how it can potentially help us navigate the markets, and even a glimpse into its history. But let's get down to brass tacks. How reliable is technical analysis? What are the potential downsides?
Those are the million-dollar questions, and luckily our source doesn't shy away from the pros and cons. It's a topic that deserves its own deep dive, and we're just getting started, ready to tackle those pros and cons of technical analysis.
You bet. It's all been pretty mind-blowing so far, but like any good strategy, I'm sure there are two sides to the coin. What does our source say makes this approach so popular?
Well, one of the things they highlight is just how versatile it is. You see, since it only uses price and volume, data, technical analysis can be applied to almost any market.
Really?
Oh, yeah. Stocks, bonds, currencies, commodities, you name it. If it has a chart with price and volume, you can use technical analysis.
So it's like a universal market decoder ring.
Exactly. And that's not all. Our source also points out the objectivity of technical analysis. Unlike fundamental analysis, which can be swayed by opinions and predictions, technical analysis is all about the data.
No more second guessing based on gut feelings. Sign me up.
Right. It's all about spotting those patterns and trends in the numbers. Emotions out, data in.
I can see the appeal in that, especially in the often unpredictable world of trading. But let's be real, are there any downsides? Every rose has its thorns, right?
You bring up a good point. There are always limitations to any approach. One thing our source emphasizes is that technical analysis, well, it relies on past data. And while that can give us clues about the future, it can't predict everything.
You mean those black swan events,
Right.
things that nobody sees coming?
Precisely. Those unexpected occurrences like a sudden policy change or a natural disaster, even a global pandemic like we all experienced, those can throw even the most well-researched technical analysis off track.
So even those fancy charts and indicators have their limits. What else should we be aware of?
Another thing to remember is that even if a pattern has played out a certain way in the past, there's no guarantee it will repeat in the future. Markets are constantly shifting and evolving.
So it's a game of probabilities, not certainties.
Exactly. And that's why risk management is so crucial no matter what approach you take to trading.
Makes sense. So don't put all your eggs in one basket, even if the chart looks promising. It seems like our source is suggesting that combining technical analysis with other approaches might be the best way to go.
You're picking up on a key takeaway. They suggest that technical and fundamental analysis, often seen as opposing forces, can actually work really well together.
Now that's interesting. So it's not an either-or situation.
Not at all. Picture this. Technical analysis is like using a map to see where you are and where you might want to go in the market.
Okay, I'm following you.
Fundamental analysis is like reading the travel guide to understand the history, the culture, the potential of that destination.
So it's about using both the map and the guidebook together to navigate the market. I like that analogy.
Exactly. By combining both, you get a more complete view of the market, make more informed decisions, and hopefully increase your chances of success.
It's all starting to click now. So we've gone from deciphering those mysterious charts to understanding the history, the principles, even the potential pitfalls of technical analysis. Talk about a deep dive. But for our listener out there who's ready to fire up their trading platform, what's the key takeaway from our source? What's the one golden nugget they should remember? What's the one key takeaway for our listeners who are ready to dive into the world of trading armed with their newfound technical analysis knowledge?
Well, our source emphasizes that mastering this, or really any approach to trading, takes time. It takes practice, and it takes a willingness to learn and adapt along the way. It's not about getting rich quick. It's more about embarking on this journey of exploration and discovery in the market.
So no magic crystal ball, just good old-fashioned hard work and a thirst for knowledge.
Exactly. It's like learning a new language you wouldn't expect to be fluent overnight, would you? It takes time to grasp those nuances, recognize the patterns, and develop your own unique trading style.
And probably a few missteps along the way too, right? Even the most experienced traders make mistakes, I'd imagine.
Of course. The key is to learn from those mistakes, refine your approach, and never stop seeking out new knowledge. Remember, the market is constantly changing, so a good trader is always adapting right alongside it.
That's a great point. It's not about finding that one magic formula, but about continuously learning and evolving with the market.
Speaking of this deep dive, it's been eye-opening. We've gone from deciphering those intimidating charts to understanding the history, the core principles, and even the psychology behind technical analysis.
We even tackled those unpredictable black swan events. Remember those? Always a factor to keep in mind.
Absolutely. Even with the best tools and strategies in place, there will always be elements we can't predict. It's like trying to predict the weather right.
Right. You can have all the fancy forecasts, but sometimes Mother Nature throws you a curveball.
Exactly. But that's part of what makes the market so exciting, the constant push and pull of risk and reward,
Yeah.
the challenge of making sense of complex information, and the incredible potential for growth and learning it offers.
Well said. It's a journey. And like any journey, the more knowledge and understanding you equip yourself with, the better prepared you'll be for whatever comes your way. Couldn't agree more. So to everyone who joined us for this deep dive, I hope you're walking away feeling empowered and maybe a little inspired to explore the world of technical analysis further. Who knows? Maybe we've sparked a brand new passion for the markets.
That's what we love to hear. And remember, if you're ready to keep exploring, connect with us on social media. We love hearing your thoughts, questions, and what other financial mysteries you want us to unravel next.
Until then, happy charting, everyone. And remember, always invest wisely and never risk more than you can afford to lose.